Hey, what's up, everyone, and welcome to the School of Personal Finance. So, the markets, they have been on shaky ground the last few months, and a lot of people are scared out there. I've been getting a lot of questions like, is now the right time to get out of the market and move to things like money market funds where I could get a 5% rate of return without any of the risk? So, in this video, I'm going to share with you the 5 secrets to becoming a great investor, and hopefully, I'll be able to answer a lot of the questions that you might have out there. All right, let's get to it. Real quick, before we get started, head over to schoolofpersonalfinance.com. Sign up for my newsletter. I'm sending out typically 1 email a week with great resources, market updates, also tools that you could use. So when you sign up for my newsletter, you'll be able to download a free budget template along with a net worth tracker that you could start using immediately. All right, so I'm going to show you some charts and some graphs and try to walk you through this stuff. But now this is not for you if you're looking for the next hot stock or what the next hot investment is going to be. This is more for those people who just want to have a good long-term strategy to invest in their retirement accounts or for their kids' college education. All right, so the first chart that I want to show you here is called asset class performance. And this shows how different parts of the markets, different asset classes have performed over time. And the point here is to ingrain it in your brain that diversification really is the key to staying invested and being able to sleep at night. So now that means that you're always going to have a piece of your portfolio that is not doing well, that you're not going to be happy with. But that's the point. You just don't know from one year to the next what is going to do well. So let me draw your attention here. They have a line with the balanced portfolio. So a balanced portfolio made up of 60% stock, 40% bond. You could see that that kind of stays in the middle throughout this chart, right? And if we look at the red is the S&P 500. So you could see that that also sort of stays in the middle. The last few years, it's actually outperformed other aspects of the market. But if we look at small cap stocks, let's look at 2022 and 2023. Small cap has underperformed pretty big over the last couple of years. So whatever asset allocation you have, whatever allocation you have towards small cap stocks, you haven't been happy with it. You've been saying to yourself, oh, I wish I had all my money just in an S&P 500 index fund because small caps really haven't done well. If we look at 2020, small cap stocks, they did outperform. 2016, they outperformed, right? We have commodities listed in here. So commodities, 2022, they did very well. 2023, they're towards the bottom of this chart, right? We had these years, 2019 and 20, where commodities were at the bottom. They're at the bottom all of these years. But you still want to have exposure to it because you just don't know what's going to happen. So typically, when I'm managing portfolios for people, my biggest allocation is going to be the S&P 500, right? That's the 500 largest US companies. And then I start breaking off smaller pieces for international stocks, for small cap stocks, for fixed income type securities, and putting a portfolio together. And a lot of it is based on your age and your risk tolerance and everything. But really, the main point and the secret of this first slide is that if you're very well diversified, it just makes the ride smoother. You don't have these crazy ups and downs where you're really freaking out and losing sleep. And now being diversified, it does mean that you're not going to hit, huge home runs, right? If you had your whole portfolio in NVIDIA stock, for example, for the last 2 years, you'd be feeling pretty damn good right now, right? Your portfolio would have done amazing compared to these percentages. But it could also drop 50% in a month, and then you're kind of left holding the bag. So there's tremendous risk with doing that. And we're talking about your long-term retirement money or your college savings money, things like that. You don't want to be taking those risks. You want to have a well-balanced portfolio that could stand the test of time. All right, and then secret number 2 is to be consistently adding money to these accounts. That is what makes 401ks, 403bs, 457 plans so powerful because you're adding money every 2 weeks. And what this does, it takes the guesswork out of it. It takes the emotion out of it. So if the market is crashing or doing very poorly, our gut tells us we don't want to put more money in there. But when you have it set on autopilot and you have money going payroll deducted every 2 weeks, it forces you to buy low. And when you're buying at that time, you don't know that you're buying low. Nobody knows where the market is going next. So it just forces you to always be active and always be adding to the markets no matter what's going on. If the market is going down, you should actually be happy because you're able to buy more shares at lower prices. If we look at this nice simple chart here called Stock Market Cycles. So the S&P 500 index since 1995. A few things jump out. Like, for example, we had this great run all the way leading up to the dot-com bubble, where in 2000, then we had this, the bust. We had this tremendous drop until October of 2002, where the market really crashed. And then we built it right back up to 2007 peak, where we just went and we crashed again into 2009. So during this time, it was a roller coaster ride, and you just didn't know what was going to happen, where the market was going. But if you were just adding money through payroll deduction every 2 weeks, then it really didn't impact your life. Yeah, yes, it stinks watching your retirement account balances, your investments go down by 40% in a year. But then let's look at what happened after that, right? So if you were to panic out at this point, just look at this growth that you would have missed out from basically 2009 all the way to current day. The market has been on a complete tear. So all of the money that you were putting in during this time period, even though it felt terrible from this period here, from 2000 to 2002 and from 2007 to 2009, all of that money, it went up, 500% basically from that year, from 2009 to the highs that we reached this year. So being forced to continuously add money, it pays off over the long term. If anything, having a sideways market for an extended period of time where you're constantly adding and then having a bull run later on, it really helps catapult your retirement accounts. All right, and then the third secret to being a great investor is to expect and embrace pullbacks. When the market pulls back, it's not a surprise. We all know that they are coming. They come often. And when they do, instead of freaking out, embrace it, because it allows you to buy more shares at lower prices. Yes, people will say this time is different and the world is coming to an end, and they've been saying that throughout all of history. But the reality is that hasn't come yet. And if that day does come, then we'll all be in a much worse situation anyway. So, you can't plan on that happening. All right, so if we look at this chart right here, this is a powerful chart. So this shows the S&P 500, the total index returns, and the maximum drawdowns, the maximum declines during the year, intra-year declines. So like, for example, let's pick a year. So if we look at 2020 right here, all right, the market had an 18% total return. But during the year, we had a 34% drawdown. This was during COVID, right? So it was fast and furious when that happened. If we look at this year right here, which is 2008, right, the market ended up down 37%, which was painful on all levels. It was a painful year. And the biggest drawdown was 48%. All right. If we look at the next year, if we look at 2009, the market was up 26%. But we had a drawdown from the highs during the year of 27%. So again, that was painful. But as long as you stick with it, you could see that overall, the market is positive in the majority of years, right? So 2022 is another painful year where the market closed down 18%, right? We had down 4% here. So there are negative years, right? These 3 years in a row right here, they were painful years, 2000, 2001, 2002. But that's the way the market goes. You have to expect these pullbacks and just look at them in the grand scheme of things, that you will be okay. And that adding money to the investments during these pullbacks, even though your gut might tell you not to do that, it ends up paying off in the long run. All right, and then secret number 4 to becoming a great investor is, when in doubt, zoom out. One of my favorite sayings, right? It's like, we could look at any short-term period in history and get freaked out because we've had a huge drop in the market. But if you zoom out and put it into perspective, it should help you sleep a little bit better at night and be able to stick to the plan and not panic sell out of the market. So if we go back to 1929, I mean, basically 1928 here, so they include the crash of 1929, you could see how painful that crash was. But as we go on, we have these drops in the market, and they look like little blips on the radar, right? Like Black Monday. I mean, that was a huge deal right there. But in reality, it's a blip on the radar. We could see from the tech bubble, right, the financial crisis. I mean, this was a long period of time where the market really did not go anywhere. But if you look at it, we've grown so much since then. So when you stop and you zoom out, it helps you kind of stay with the plan here, that you have to stay invested. And then secret number 5 is, do not think that you or anyone else, including me or anybody you see on CNBC, do not think that anybody could time the market. Everybody has their own opinion. Everybody uses technical analysis and charts and earnings and all this stuff to try to stay ahead of the curve and try to anticipate where the market's going and try to time the market. It is a fool's game. It is very hard to time the market. You could put 10 of the smartest people in the world in one room and they will all have a different opinion about what the right move is to do next. So how do you make sense of it all? And really, if we just look back at history, if you just have a well-diversified portfolio and you stay invested, that has really been the answer to growth over time. So here's another chart. This one's called the value of staying invested. And I know I'm beating the same drum here, but this one is interesting. If we look at $100,000 invested, all right, and then we go through the financial crisis. So that $100,000, you could see that it was worth less during the financial crisis in 2009. So you basically went 10 years here and you were down, all right? You had a negative return after 10 years. So at that point, these three different lines represent actions you could have taken at that point. So the biggest growth one, that is if you did nothing. If you just held on and didn't do anything with your portfolio, it would have grown to $721,585, all right? This next yellow line is if you were to basically panic sell at the bottom and move to cash for 1 year. If you said, you know what, I'm going to give it a year for the market to recover, for the economy to recover, for the world not to come apart at the seams, and then I'll invest again. So if you did that, then your initial $100,000 investment, it would have grown to $438,000. And then this last line here is if you would have said, screw it, I'm done with the markets, I'm moving to cash. All right. And you would have sold at the bottom of 2009 here and just went to cash. That would currently be worth $138,000 and change. So you could see what a huge difference it makes just by doing nothing, just by staying invested and not panic selling and staying with the plan there. So those are my 5 secrets to becoming a great investor. Now, at the end of the day, I know that this isn't rocket science, that these aren't some amazing secrets, that you've never heard before. But the truth is, people don't do it. People don't act on this stuff. They do panic sell. They don't stick to the plan because our emotions take over. And it's very hard to stick with it when you feel like you're losing your hard-earned money. But in the long run, that ends up being the best thing to do. I hope that you found this one helpful. Please leave me a comment below. Let me know that you enjoyed this video. I'm going to try to be banging out more and more content on here. I'm making videos down to my basement now, a little bit of a different look, but I'm going to try to get back onto the main level and get back to my old spot that I'm comfortable in making videos. But yeah, good to see you. Hope you enjoyed this one. I'll see you again soon. Take care. Thanks.